right, so welcome to the Capital Discussions Weekly Market Analysis. I'm Tom Nunemaker with Jim Riggio and our guest Tony Sizemore today. Before we get started, we'll just go over our disclaimer that's on all of our web pages down at the bottom. Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, Jim, did you want to share your desktop?
Certainly, Tom. So you
have the ball.
And let me just get my current graph up.
Yeah, I thought you'd enjoy that picture, seeing it again.
Yes, I do. It's
a picture is truly worth 1,000 words. That's for sure.
Absolutely.
Tony, I don't know if you know, it's being down here. It usually only takes literally a summer, or I mean a winter or two, for you to turn in, like for me, turned into a complete weather wimp. In that short period of time. Oh my God! Okay.
Oh, believe me. Well, I just got back from Destin, our house in Destin, a week ago. I was down there for almost.
You had a house down there.
Yeah. We've had that since 2002, and I was down there for a month. I've kind of felt guilty. Well, I don't want to take up your time telling you what happened, but I'll give you the really 30-second version. We went down on vacation, with the family, all the kids and their girlfriends and some friends and stuff. And we took, I drove with my wife. I didn't bring my car. We all went together. And I said, well, I've got a lot of paperwork to do. I've got some year-end stuff, this and that. And she said, well, how about I just leave you here and come back and get you, in a week or so. And I said, yeah, that'll be fine. That'll be fine. So she leaves me there, right, without a car or nothing, and all I had was a pink bicycle. So she left me there for a month. She left me there for a month, literally. And, but the good news is that that's all I needed was a bicycle. Yeah, I could go anywhere I wanted.
That's all you need in Destin. I was only to Destin the first time about 2 years ago. We went over the summer. We drove from South Florida to New Orleans. Okay, we took 10 days to get there and like 5 days to end up getting back. It was great. We spent 3 days in Destin. And what's the next town? Is it Fort Walton? Is it?
Fort Walton is west of there, yeah, and east of there, of course, is Panama City.
Yeah.
But we're kind
Panama
of in
City is not nearly as nice as Destin. Destin was very.
Oh no. No, Destin is, it's a different world altogether. But, the good news is that, I only traveled within a couple of miles of my house. I had the cigar store, the liquor store, and Publix, and that's about all I needed.
That's all one needs in life, really. Anyway, can you guys all see my screen?
I can.
Yeah, I can see it.
Okay.
Go ahead. I'll shut up.
Here are the things that I've noticed, and I've mentioned this over the last couple of times when we've done this, is that the technicals, and let's go over, because this is my oscillator page, okay, that the oscillators had been getting weaker, okay? Nothing has broken down yet, but we are definitely, looking at the strength of the up move has slowed down. As I go back, and, we talked a little bit about this, and we talked, I think, was it? Yeah, it was right after our meeting that we ended up having probably about 3 weeks ago. We had pulled down so hard, so fast, and it was amazing the way we ended up rebounding. All of the technicals ended up, you can see that the technicals all around, right after we end up pulling back. As usual, CCI and Williams percent R were the first to break up, higher. and they started to give back a little bit, but they're still in a place where they're relatively strong. One of the expressions that I end up using is that when I take a look at the technicals, and some people think that they're overbought, the way they have gotten here, they can end up living on the ceiling, so to speak, for a long, long time. I don't see things breaking down that much. What I do end up seeing is a lot of things going on in and around the implied volatility, and I'll end up taking you through some of that. Tony, before I end up leaving this, or Tom, any comments just on the oscillators? Because at this point, going into the end of the year, you don't see a lot of sell-offs going into Christmas. We got a little bit of a scare last night when GDP out of Japan came out negative for the second quarter in a row, okay, putting them into a technical recession. They were weak. Europe was weak. But we seem to end up getting stronger, okay, throughout the day. So I didn't, I'm not seeing any signs of imminent, concern. Next January, okay, is a different story, but we can talk about that. We have lots of time to talk about that later on. But for right now,
I was just looking at like on our members site where you have all the upcoming economic events, and there's a lot of red in the next few days, including the FOMC meeting minutes coming out. So it kind of looks to me like the market hit the pause button for the last few days. If you just go to that, the member home, so you see there's a lot of red on there, market moving events.
Yeah, it's one of the things that I take a look at. It's of everything that's going on, I think that things are kind of incremental at this point. Yes, all of the economic numbers coming out, but I think that what people end up being most concerned about over here, it's more the international stuff. If I take a look at what specific one I'd end up worrying about, or in terms of, could be a market mover, it's the language within the FOMC minutes. We've gotten through our quantitative easing, we're all done, and we think that right now it's kind of like a race between the Fed and the Bank of England about who will end up raising rates first. The Bank of the ECB, Mario Draghi and company, they're still struggling. Countries had been weaker than expected. I was concerned about last week, one day, when all of the GDP numbers across Europe came out overnight. And it was interesting, they were pretty much on par. Maybe a couple of countries were slightly less than expected. But the market, it really didn't end up moving the market. The quantitative easing that's going on in Japan and the subsequent recession, is something I think that will end up impacting the markets because, I don't know, we talked a little bit about this, that Japan, even during the height of the Greek debt crisis, Japan had a higher debt to GDP ratio. And with their GDP and their economy contracting, this does not end up helping them. They're going through massive quantitative easing, and the way they'll end up basically handling their debts, because they have just huge demographic issues, is going to be to weaken the yen. So with the weaker yen, that basically, when governments give out quote-unquote free money because they're just driving their own interest rates down so much, that's basically a risk-on trade. And as we finally got done with all of our risk-on trade, meaning the quantitative easing ended, now, you have a little bit in Europe, but an awful lot in Japan. So those are the things that I end up seeing affecting the market, but nothing that is, a sharp, major concern immediately.
I also noticed that the Russell's been selling off the last few days versus the SPX is just kind of flat to slightly higher.
Yes, when you take a look at the Russell, and I can do some comparison charts in a second, um, but the Russell, now remember, the Russell led us higher for 2 years, and over the last, couple of months, especially when we had the pullback. If you remember the pullback that we ended up having, okay, in October, okay, late September, early October, it was the Russell that let us down. Okay, it was the first. It was weaker. One of the things that we also end up having, I think I ended up sharing. Um, I've checked, Tom, with a couple of the people that we ended up talking about, and yes, um, I work with a portfolio manager that manages about $500 million, okay, in an equity strategy, and basically they're stock pickers, but they're a top-down stock picker, and they they're doing their quarterly rebalancing again, and again they are continuing to um, lessen their small caps and move to their larger caps. They're all U.S. equities. The other report that came out last night, I don't know if people had seen it, but J.P. Morgan came out with a research note saying that that European stocks have been beaten down so far at this point that they've been beaten down to the point where they are suggesting that we take a little off the table in U.S. equities and move to European equities. EFA is probably the best example of the European equities, and the ones that have just gotten absolutely killed is the emerging markets. As you take a look at how the markets have moved up over the last couple of years, they have just totally left EEM and the emerging markets, in the dust. If I compare this graph in EEM, where you can see that we basically have moved sideways during this time period, and I take a look and compare that to the SPX, I mean, it's amazing the difference. The SPX is up 50% in the time that the EEM has just basically moved sideways.
So do you think the Russell might lead the SPX lower short term, or what do you, any guesses?
We have. One of the things that I end up looking at all the time is that this is a chart that I leave up constantly. And you can do it 5 minutes. The reason why I leave this chart up in 1 minute, and just to let you know what it is real quick, I look at the E-minis because the futures will give me volume. I would never look at SPX. I'd have to look at the E-minis or the SPY because I want to see volume. And then I could put up the VIX futures, but the VIX futures, I'd only end up looking at 1 month. I wouldn't look at multi-months, and so I couldn't see what was going on in multiple months. So using VXX actually has the first 2 months, and it has some of the, the roll that they have to do where they're selling the front month, buying the second month. And there's enough volume in this because of arbitrage and institutions playing in this thing that I like to end up taking a look and seeing, is there anything being driven by one side versus the other? The thing that was, we had commented, if you take a look over here, the VXX was down 21 bips, right? We always talk in bips, right? Decimal 0.21 or 21 bips, where the VIX was up 5.11%. That was basically a catch-up from Friday, where the where the VIX kind of took a real big hit at the end of the day, but the futures didn't, right? The futures kind of held on, and the VXX kind of held on to some of their value because of let's just call it uncertainty over the weekend. But it all caught up today, where the VXX basically was flat, down a drop, but the VIX kind of popped itself back up.
Hey, Jim, it's Tony. Could I just ask a question here now that you brought this up? This is actually one of the things I wanted to ask you. VXX. Okay, so Well, let me preface it by saying I agree with you that, the season is bullish. I do think that the markets or the major market indexes are probably going to have a couple of spikes, up, down, but no real difference in trend between now and the end of the year for a variety of reasons, which you just pointed out. But with that said, VXX, what do you think about getting long that instrument somewhere around where it's at right now, due to the fact that we're going to experience higher interest rates, and let's assume that the economy does pick up and everything, and we don't have to talk about specific ways to trade the VXX, but I would like to get long the VXX for the foreseeable, for the next period of time. It appears to me that it's probably found a floor. What do you think about the and what I'm referencing really is the Lynn Yates, and McMillan sort of model for that. What do you think about that right now?
Their whole VXX or 14, right? The XIV. Right, for those who are Roman numeral fans.
Well, XIV would be they would be long the XIV right now, right? Because, well, I guess what I'm trying to say is that I got a signal from Yates about the switchover, from being long XIV to being long VXX, and I'm not sure that panned out because it was kind of a spike, but
yeah,
my understanding...
I'm pretty sure it didn't pan out because of the way it ended up spiking so abruptly.
Yeah, and then reversing because of what we saw. But what do you think right now? Well, not right this very day, but let's just say going into the end of the year, first quarter of next year, do you foresee that VXX is going to continue to decline, or do you see something that might give us a signal that we might want to start thinking about being long that thing?
Okay, Tony, are you familiar with their issues in and around their roles?
Yes, they partially.
Okay, so let's go over that real quick. For those of you, I know some of the folks who listen to us on a regular basis have heard that, but I know that if there needs to be at least a few folks that haven't heard this before. The VXX, okay, brought to market, okay, in 2009 by Credit Suisse, basically tried to replicate the VIX, but because the VIX is not tradable, you can't replicate it by buying the SPX options underneath it. So what they ended up doing, the only way to implement this on any type of scale was to basically average a 30-day VIX future. So what they end up doing is that they use the front 2 months. And every single day, they have to keep the average at 30 days. So if there was the front month future was trading at, say, 15 days to expiration and the back month was at 45 days, they would just use 50% of each of them. But what happens tomorrow when there are only 14 days in the front one and 44 days left in the back month? That means that they have to sell some of the front month and buy some of the back month to move the average, okay, expiration back up to 30 days. So what you're looking at here, this is a pretty simple graph. If you take a look at it, all this is are comparisons. So for example, the green line. The green line is the second month VIX future. You see that right there, the VX Z4 minus the VX X4. And I look at it on a 15-minute moving average, and what this is how much the second month minus the front month in green. The next one is nothing but the third month minus the second month, and the red line is the fourth month minus the third month. The purple line, which is the front month future minus the VIX, is the one that has the most noise in it, and it's totally meaningless, but I kind of like to end up seeing where it's trading just to kind of give me a frame of reference. What you can end up seeing here is that we have gone more and more into contango. What is contango? Contango is when the second month is higher than the front month and the green line is positive. Okay, here's the zero line. If you would prefer to end up seeing this on what the contango curve looks like, the website that does a pretty good job of it is VIX Central, and it ends up showing you as a percentage what the second month minus the front month is. And see, all they did over here was that they took the second month futures minus the front month futures. Right, so they took the Decembers minus the Novembers. Now, don't forget the Novembers expire on Wednesday morning. So what will end up happening is that you'll end up seeing, okay, the front month, okay, become December, and the second month become January. So we'll end up going from a contango of 6. Now, you also have to do the math, and we don't actually do this. We keep a spreadsheet where we've kind of dissected what the VXX currently is, so we know what's driving it in terms of which month we end up having in terms of futures. The bottom line on your question is that you have a large contango drag going into the VXX, number one. Number two, you're going into a seasonal piece that, in my opinion, is very difficult for volatility to mount any type of charge higher at this point. So getting long VXX is not something that is, has seasonally proven to be a winner, getting long volatility before Thanksgiving. And the contango drag is also showing that becomes more of a challenging trade. But having said that, if I wanted to end up getting long, let me do this. Let me detach a page, and let me get rid of all of this crap. And if I wanted to get long the VXX, one of the things that ends up happening on the VXX, it's a bit of a challenge, and let me show you why. It's easier to show you on LiveVol. If I take a look at the implied volatility of the VXX options, right, and I'm looking over here, look at how much the implied volatility moves up. You know what, let's do this. Let's go and take a look at, we have too many strikes here, so let's just take a look at 12 strikes up and 12 strikes down. That's probably a little bit easier for you to see. Okay, so what you'll end up seeing here is if I take a look at the implied volatility and how it ends up moving, it's probably easier to take a look at it on a skew graph. Okay, and let's just take a look at 25% up and down. What happens with volatility, it's the exact opposite of the RUT or the SPX, in the sense that normally the calls are relatively low compared to the puts on the SPX. Here, the calls are going to be much, much higher. So what you're looking at along here, the y-axis, is the implied volatility of the different options. Along the bottom, you're looking at the strike prices of the options on the VXX, and each one of these graphs is over here in a different color. So if I take a look at just say the first 6 months, I can end up seeing that the skew, meaning how much more the calls are than the puts. So if I wanted to end up getting long the VXX, I can tell you, and you can go back, by the way, and it would take a little while, but I can end up going back up till 2 years on this, and I can hit play, and I can watch how the skew has changed every single day. And I can tell you right now that the skew is a little bit lower than it normally is, but not by much. So what would I consider doing if I wanted to get long? I would end up first saying, well, what am I concerned about? Am I concerned about the VIX going to 15, or am I concerned of it going to, 25? Am I concerned that the VXX will go from 28 and change up to 32, or where? Normally, Tony, I always take a look and saying, how am I going to define my edge? Okay, and the way I kind of take a look at defining my edge is that if I know if I can buy a lower implied volatility and sell a higher implied volatility and get the trade on that I want, that's a better trade. So what I would end up considering is, not going into April. I mean, not going into January. I would either play this if I was concerned about a short-term move, playing the front month or the front couple of weeks, where I would be buying a call and then selling a higher call, so I'm effectively buying a call vertical, is a very reasonable trade, because if I take a look, let's say, for next week, okay, and I did something like I bought the 29 call, and you can see it right here as I hold it over. Has an implied volatility of 50. It's bid at 77, offered at 82. And I did something like sell, let's say, the 31. And I got, you see it's bid at 38, offered at 43 cents. It's a 62 and change vol. I'm buying a lower vol, and now I have something that's a reasonable edge, where I can end up playing that vertical move higher, and I'm offsetting the natural drag on the contango, the pullback that I would normally be fighting, because I'm getting so much higher of an implied volatility on the 31 call that I was selling versus the 28 or 29 that I would be buying. So how would that end up looking? Let's end up taking a look at clearing my sims here. And if I did something like we talked about on the call side, right? If I ended up, let's say, buying one, I always do one lot. It's just easier. All right, selling one. Okay, and I went to take a look at my chart, and I took a look at my sims only. I had it on a different screen. Here's what my implied volatility is. Let's take it. Okay, where, on something like this, I'm risking $45 to make $155. If I was worried about a pop, that's the type of risk that I would end up playing. To me, that's a very good. If that's too wide, I can get, say, plus and minus 15%. I always like looking at the next 8 days. I had a long conversation, by the way, with the guys over at LiveVol, because they don't have an expiration graph. And I said, a lot of people are used to looking at expiration graphs. And the challenge, okay, with an expiration graph, especially if you have a butterfly, people actually look at how much money they could make if they stick the landing right on the short strike of the butterfly. And
yeah, very bad practice.
That's a very bad practice, and the guys at LiveVol said, we're not going to do it. That number is a mirage. You don't have a chance in hell of making it, so why should I show it to you?
Good point.
And, it's hard to argue with that, but I want to see it anyway, okay, people would say. So, this is the way I would end up playing. Now, if, my other, choice of doing something like this was if I didn't end up doing it in the front month, but I ended up going, let's say, further out. I started to look at, I was concerned that they were going to end up raising rates and that March could end up being really ugly. Going out and doing something a couple of months out, maybe, and you can see the implied vol here, right? So if I bought, say, a 65 vol, and at 30, and I sold a 78 vol, right? And then I went and I took a look at something like that.
Hmm.
Let me come over here and take a look at it. Oh, I just want to look at just my SIMs. Let's go out 50% in each direction. And over here, instead of looking at days, let's look at the next 8 weeks. So something like this, okay, is a longer-term play on vols popping. Now, if you were concerned about that, what I would end up doing is that I would put this trade on, let's say if you wanted to do it 100 times. Maybe I put on, 2 to 5 contracts a day between now and the holidays. Why? Because volatility is probably going to end up coming in. And I love the concept of building the trade because I don't know if vol's going to end up coming in or when it comes in, or if it does pop, will it pop before
Right,
Christmas?
right.
So over here, when you go all in, okay, I
Yeah,
kind of,
which is I never recommend that to anybody, especially myself. But
I don't
but
know
you're
about you, but when I recommend it to that person, he doesn't listen so well sometimes.
well, no, you're exactly right. If you're going to build a position, I mean, building is by definition takes a little bit of time. You're able to average in. I want to zoom in specifically on something. I understand exactly what you're saying about the skew. You definitely want to be, depending on whatever strategy you use, you obviously want to take advantage of a skew if you can find it and get it. Now, what I was thinking about is, since you had mentioned the drag for the contango, a lot of us get confused when we start talking about, the contango drag and, most of us understand that, they have to sell the front month, buy the second, the futures just to keep it at 30 days. But what I was trying to aim at was, and I guess I'm trying to just get a shortcut here. What would cause the contango drag to flip? In other words, what would be, because if you look at VXX, I mean, it's been going down for, ever since they invented it. Okay. So, is it a plausible strategy? Forget about whatever the tactic is, but we've not seen VXX go up. Well, we've seen some spikes, but what would cause the turn, other than, of course, a bear market? But could there be a sideways market that would cause, the drag, the contango drag to go back to neutral, or what do you think? Because that's really the philosophy of it is kind of what I'm struggling with. I'm not really sure. I've seen charts like that before where they just died off and, went by the way of the dinosaur. Just don't know.
But when you take a look, you see over here where we're totally flat?
Yeah.
What happens when I do this?
Yeah, right. I know it's such a big scale that you can't see the move.
It's such a big scale that you don't see.
Yeah.
Look at what ended up happening. We went from 26 to 44. Not quite
almost
doubling, but we were trying to double in less than a month.
Yeah, so I guess what would cause the I don't even know the right words to use, but what would cause the tailwind to get behind the VXX for, even if somebody like me was just going to say, well, look, I just want to buy the thing. I don't want to, obviously I'm an options trader, but maybe I just want to get long it. What would, in your opinion, given the circles you run in and everything, what do you think would be, the tailwind? I mean, what would, I mean, is it basically just higher rates?
This is a good graph, okay? And I took a one-year graph, and what I basically did was that I mapped out the SPX in the bar chart,
okay,
and the purple line is the VXX, and you can see that the VXX will end up spiking when there is a significant drop. In the absence of a drop, okay, over here, in the absence of a drop, we will
That's a good area right there. Yeah, that flat area.
Right, the flat area, you'll see that we'll move sideways, and over here, and here, by the way, this happens all the time. Once the market tries to sell off, and it can't, okay, going back to the football analogy, it's like when somebody gets in the red zone, they get real close to your end zone, but they don't score. It's such a deflating thing for the team that doesn't score. It's such a deflating thing for the VXX when they try to drive down the market and they can't, and it pops back up. At that point, it just
they
gets
give up
really
the ghost.
Yeah. That's exactly what happens. It's kind of like they give up. So you kind of have to end up watching that. If you take a look at this, let me also do another comparison in here. Right. Let me compare this to the VIX so you can see what happens with the VIX.
And while you're pulling that up, Dave Stewart mentioned that you need backwardation, and bottom line for him is you can only trade the VXX from the long side for a day or two or three.
Yes, unless you get into heavy backwardation for an extended period of time like we did in 2008. Otherwise, I agree 100% with him. Okay, and let me hit up. Okay, so you can see here, and this is a good example of. Look at what happened to the SPX. It got to be so small on the scale because look at how much the VIX over here ended up moving higher compared to the drag of the VXX, right? The VXX over the year is down nearly 40%. You see that in purple over here, where the VIX is actually up 7%. So that's that. I mean, while there's a high correlation here, there's a lot more drag, and that drag is, it's mostly the contango. It's also a little bit of the mathematical formula. Without becoming a total math geek on this, I'll just make this one comment. The VIX is a calculated index off of the options. So therefore, if the VIX goes from, 10 to 15 back to 10, and I'm using that so I can show a 50% rise in it easily, and the math all works out. That's not the same as if you actually own the security, because the VXX is using longer dated futures, and they have their natural decay that ends up happening in them. And so what ends up happening is the movement will end up hurting the calculation of the VXX. If I go back just to this real quick, Tony, you take a look at this. Look at how, if I go out to June, how much higher the June futures are trading than even the January. So they have this natural decay, and this is,
that's the drag right there.
You can see the drag. Very simply put. And by the way, this is a very normal curve where the biggest drag is between the first 2 months. And here, one of the things, you can just go across and look at this. Look at how, okay, this one isn't perfect, okay, but other than months 5 and 6, the percentage difference just keeps getting smaller and smaller and smaller. This is nearly a perfect contango curve. So what you're asking me is, what would drive the front months up? There needs to end up being some level of fear.
Okay, so basically it would be the classic, enter into a bear market where we have some sharp movement that is sustained, and so forth. Well, it's interesting because I was thinking to myself, and maybe some other people have thought this way. That's why I wanted to ask you. I was thinking that the VXX being, how far it's come down, how low implied volatility's been for so long, we're getting the feds that are going to tighten, to whatever degree and however long it takes them. I was thinking this is almost like a golden goose. Like, how could I really, of course, every time we say how could we lose on a trade, it finds a way. But my point was that it just seemed to me that it would naturally begin to rise even if we had a sideways market. But you've just disproven that for me. So that gives me a lot better idea. And maybe some other people were thinking the same thing. But yeah, that explains it, a lot better than the way that I understood it. So I appreciate that.
Okay, and I'm just trying to look and see. Okay, let me come over to here. If I wanted to take a shot that I thought that, after January, let's say by March, I was like really concerned that something would happen, and I wanted to take a low-risk shot that vol would end up moving up somewhat. Let me get a few more strikes in here. If I'm concerned, let's say we move up 50% or at least 20% on this thing, maybe we go from back up towards 40. By doing something like buying, a very, very wide butterfly above the money and doing something like, let's say, a 30, 40, and can I get anything? Oh, yeah, I can get plenty of money for the 50s. Okay. How about something like this, Tony? Okay. 10-point wide butterfly in March, centered at 40. I'm risking 94 cents to end up making, right, you can just do the math, 10-point wide butterfly with $9.06.
Yeah, and look at that upside potential beyond the tent. Yeah,
now the skews are wrong on this, by the way. Don't ever, if you guys model on Thinkorswim, do not believe the T+0 line on any of the volatility products. They do a pretty poor job of that. I would not trust that at all. Now, one of the things I take a look at, I always do, is I say, well, how much? 94 cents. How about if we did it in January? 91 cents. Maybe, I don't know what's going to happen. Maybe I put some on in January, some on in March. Do I think that we would have a longer-term pull? I don't like longer-term plays in the VXX because it's even when it ends up having a really big run-up like it did here, it's very difficult for it to sustain it. I mean, it has to end up staying, it has to have some reason to end up staying that high.
That's a really, really, really good point right there. And what happens to most of us, some of us, I guess, me included, is that sometimes in our options trades, we might have something that is a negative vega trade, and the market posts a spike like that for a couple of days, and we get shaken out of it, only to watch it, come crashing back down. So that happens a lot. You're right. Sustaining a higher move in implied volatility would also necessitate a sustained bear market that lasts at least a couple of months, not this 1 week wonder kind of thing that we've seen over the last 2 years. So.
Right.
But yeah, I kind of, I didn't mean to distract you from what you were going to present. I just wanted to ask you about that because it's been bugging me because I've been sitting here thinking I don't quite understand the XIV VXX trade, but it appeared to me that, well, you answered my questions. As with anything, is no golden goose.
What I'm going to end up doing is that on December 4th, okay, to end up letting you know, on December 4th, we're going to have I've been helping a former Goldman Sachs trader because while he's a great trader, he did not understand how these things end up working. While the work that I do with him, he'll share whatever he feels he can. I'm underneath non-disclosure, but what I can end up telling you outside of the non-disclosure is that you can't trade this thing long term. You have to trade it so that it will decay. The decay is built into the options pricing. So if you think that you can just buy a put and make money on this, you're wrong. You will get shaken out if you end up trying to trade any type of adjustment style. Okay? What you have to end up doing on this is waiting, keeping your powder dry, putting on a trade, and pretty much putting on, expecting to lose whatever you're going to put on a butterfly or a vertical. And then at the end, you have to end up taking advantage of how that vol skew really spikes. Those were the components that I was asked to look at, and those were the things that we ended up building. The other thing that we're going to be doing on December, Tom, what was the next date? It was the 18th that we had?
Yeah, the 4th or the 18th.
The 4th and the 18th. So ex-Goldman trader Ian Scott will talk on the 4th on how to think like a trader, because on the VXX he will tell you that it's very different than other types of trades. And then on the 18th, we'll end up having Bill Visconto from EAB Investment Group, and he's going to go through how the vol skews have changed a lot and how come your iron condors don't work the way they used to.
I'm sure a lot of people want to hear that.
Yeah, that's a good topic. I was talking about that today with someone, as a matter of fact.
Yeah. So what they end up having is that they've been vol arb, they being EAB Investment Group, so all of the partners there, they've been vol arb guys, volatility arbitrage guys in companies like Goldman Sachs and others, and they've traded each one of the partners there have been trading this for at least 20 years, and they'll go through and show you how in a low vol environment with the skews as steep as they are, very difficult to end up making money. We need to end up having a very different market for them to end up trading. Will we ever go back? They've talked to one of their former colleagues runs a over $1 billion fund on trading nothing but VXX and volatility type stuff. And that market has changed dramatically over the last 18 to 24 months. So it's much, it used to be easy to end up just betting that this thing was going to go down. Now it takes a little bit more planning and a little bit more timing to end up getting into the market on this. So.
Well, Jim, I appreciate you, having me on today. I know you guys have more stuff to talk about, but I'm going to go ahead and sign off because I don't want to take up any more of your time, and maybe you have some questions from other people.
And this was a great conversation, Tony. We really appreciate you coming on. You're welcome anytime you're able to. I always like talking with other traders. I think that if it's on your mind or if it's on your clients' minds, it's on the community's minds, and I think they're great conversations to end up having.
Well, thank you very much for that. I appreciate the opportunity. I for one am not scared to say I don't understand, because I trade as a business, and when I don't understand something, I want to talk to somebody who does, so that ultimately I can understand it. I think that a lot of times, obviously you've got some brilliant people that are here with you guys. So for me, if I don't understand something, I want to go to somebody who does. Period.
It comes down to trading it, right, Tony? It's a lot of these things. I'll tell you, it's we had done quantitative analysis and back testing, systematic back testing on this stuff. But the experience you get actually trading it and watching how things end up moving and seeing how to end up getting in and out of things, and where you can put on size and where you can't, and when they'll end up being very generous with their pricing and when they'll be stingy with their pricing. A lot of that ends up being, experience, and I don't want to stand here and do a monologue on what happens if something happens. I'd much rather have a two-way conversation to answer questions of what's on people's minds. Just the way MK ended up asking, would we do call spreads, okay, to take advantage of the skew? And the answer is without question. That's the way I think you have to trade this. I think that, buying calls on the VXX is a sure way to end up losing money. Over time, you'll hit it big maybe once or twice, but for every once or twice you win, you probably have 50 losers.
Yeah, a hell of a grind.
Like David just holds them for a couple of days, so maybe that's the exception.
Yeah, well, I think you've, I think you've explained it, as well as anybody could. It enlightened me quite a bit, and I appreciate that. Well, anyway, I'll let you guys finish out what you're doing. I want to thank you for having me on and letting me be able to talk. Tom, it's always good to talk to you. Jim, of course, you enjoy your summer evening.
Yeah.
Sorry,
man. It's dark here right now.
Yeah, it's getting dark here, and it's going to be cold too. But yeah.
I'm a few hundred miles to the east of you, though.
Oh, that's right. Well, that is right.
And I'm a bit further.
Yeah, you're a little bit more than a few hundred miles east. It's like the sun tomorrow morning.
Tom's like the sun's getting ready to come up, guys.
Exactly.
I got to go to sleep. Well, okay. Well, anyway,
Tony,
thank you very much,
everyone.
Jim.
Appreciate it.
Yeah,
Tom, any last thoughts?
We have the trading groups on Wednesday. I've got the trading group 2 at noon Eastern, and your trading groups at 8:30 p.m. So hopefully, if you can attend those live, those are great. We have some good discussions. And then Amy Meisner is coming on Thursday on the roundtable. She'll be talking about her weird or variation that she's trading now and going through some trade examples and her setups and stuff. So that should be pretty interesting.
Yeah, and Tom, I'm not going to be part of my trading group this Wednesday. We're going to see if Paul Demers can't end up running things. I actually have a client dinner that I'll be going to this Wednesday.
Well, you have to reschedule those around the trading group, yeah.
The problem is he wants to go out for Indian food to a particular restaurant, and they have this big thing on Wednesdays that he likes to go to. So, you know what? Anybody want to give me $1 million, okay, in my fund? I'd be more than happy to cancel him and end up doing the trading group. How about that?
There you go. That's fair enough. All right. Well, thanks, everybody, for your time. We appreciate it, and we will see you in other meetings this week.
Okay. Take care.
All right. Thanks. Bye-bye.